Welcome back. In this video, we'll explore breakout trading strategies during high volatility events like inflation reports or central bank interest rate decisions. These economic announcements can cause big market swings. They might seem unpredictable, but with the right approach, you can turn that volatility into trading opportunities. Keep in mind, not every announcement will lead to a big market move. Volatility tends to spike when the actual data doesn't match what was expected, often creating the strongest price breakouts. Arguably, some of the most impactful releases include interest rate decisions, inflation reports, and employment data. You can stay updated on these events by using an economic calendar. After choosing an event you want to trade, here's how to approach it. First, before the announcement, identify key support and resistance levels on your chart. These levels will guide you during the event. To identify these levels, you can use several forms of technical analysis, from Fibonacci retracements to Bollinger Bands to moving averages. Next, plan your entry. There are two ways to enter. A breakout entry. Wait for the price to clearly break above resistance or below support. This usually signals strong market sentiment. A confirmation entry. Use volume or momentum indicators to confirm the breakout before jumping in. Then, manage your risk. You can use position sizing. During high volatility, it's safer to trade smaller amounts to limit your risk. Stop losses. Place your stop loss just outside the support or resistance level or beyond the breakout point. Take profit targets. You can use trailing stops or set specific profit targets based on the currency's average daily range or your risk-reward ratio. Let's take a look at an example. On June 10, 2022, US inflation data was released. Before the announcement, let's say you set up your Euro-USD chart, adding Bollinger Bands and marking key support and resistance levels. Based on your analysis, you expect inflation to come in higher than expected, which could strengthen the US dollar and therefore weaken the Euro-USD pair. You decide to place a sell stop order at 1.0565 in case the price breaks below the lower Bollinger Band, with a stop loss just above at 1.0580 and a take profit at 1.0520, setting a 1-to-3 risk to reward ratio. When the data came out, inflation was 6%, higher than the expected 5.9%. The USD strengthened, causing the Euro-USD to suddenly drop, enacting your sell limit order and later hitting your take profit target at 1.0520. It's important to note that not every economic event will lead to a tradable breakout. If the actual data closely matches expectations, the market might not move much. That's why it's always crucial to do your analysis and avoid trading on impulse. Advanced traders also often use multiple timeframe analysis to confirm breakout signals. By combining short-term chart signals with long-term trends, you can increase your chances of profitable trades. Successful breakout trading is about managing probabilities and controlling your risks. Always do your research and never risk more than you can afford to lose. Try using a demo account to simulate these situations without risking real money. Track your trades, analyze the results, and refine your approach as you go. And that's it for this breakout news strategy. In the next video, we'll cover Forex scalping strategies. See you then.